Now, I would like to tell you a little bit about our host, Professor Lamont Black. Professor Black is a recognized expert on cryptocurrency and blockchain who is a regularly invited speaker at conferences and in the media. His teaching on cryptocurrency at DePaul covers aspects of money and investing and has been featured in the Chicago Tribune. In his graduate course on blockchain, he works with business and computer science students to build real world blockchain applications. Without further ado, I would like to hand it over to Professor Black.
Well, thank you, Harlan, and it's a pleasure to be here. Great to see that we've got so many people interested in this topic. This is a fascinating area, and I hope that the next hour will be well worth your time. So as Harlan said, I'm Professor Lamont Black, and at DePaul University, I've been here for about 8 years in the finance department. I teach money and banking, as well as courses on data analytics, and in particular, a graduate course on blockchain and cryptocurrency that I'm actually teaching this quarter. And I've got some students from several different courses who have joined today. So this is an area that I'm very passionate about, and I hope to be able to give you some additional insights into this area. One other thing about me is that my background is with the Federal Reserve. I was an economist in Washington, D.C. during the crisis. And so I'll be sharing a little bit about how the story today relates back to that period, but very happy to be at DePaul and in Chicago. So as Harlan said, I want this to actually be pretty interactive if possible. So rather than me just talking for 45 minutes and then doing Q&A at the very end, I'd love for you guys to have an active role in the chat. You can either post comments or questions in the chat. I'm just going to say hello there, and you should be able to see that. And if anybody wants to say hello or just go ahead and put anything there, I'll be trying to keep an eye on that for questions as we go, and Harlan as well. And then also, if you want to ask a question by audio, you're more than welcome to do that. So we'll be using the Zoom raise hand feature. If anybody wants to go ahead and try that, then maybe we could just do a quick one. So I've got Dimitri. Dimitri, you just want to say hello and why you're interested?
Hello, can you hear me?
Yes, go for it.
Awesome. Yeah, I'm sort of investing in crypto, so I was just kind of curious to see your perspective.
Awesome. Great. Thanks for volunteering to do that. So like Dimitri just did, feel free to raise your hand, and I'm happy to call on you. And I'm just going to try and run this almost like a classroom session. So this topic, I think, can go a lot of different directions, and we are going to try and focus on investing in this particular seminar, and so I'm going to give you some background on this kind of area of cryptocurrency, but then also some thoughts about how people are starting to view this as an investment asset class, which I'm guessing some of the people on this call are already investors, and so I'm going to try and give you some tips for how to get started, but also if you're already investing in this space, how you can potentially continue to kind of evolve your investment strategy. All right, so before we get started, let me just mention a few quick things. I'm going to share my screen on occasion throughout this talk. I'm not just going to show you a bunch of slides and talk at you, but this is kind of how I run some of my classes. This first page here, this is my personal website, and I bring this up for a couple reasons. One is I've tried to start putting as much of my content online as possible in this public way. So if you are interested in any of these topics and you want to read more or see what sort of other things I've shared, either in the content I've written or some of the other media, like podcasts that I've done, this is kind of my one-stop shop for all things that I'm working on in this space. And you can even see there's a link here to the course that I'm teaching on blockchain and cryptocurrency. There's 10 different modules. And this is what I'm working through with my grad students. And I'll kind of hit some of the highlights today based on these topics. So my guess is most of you are familiar with Bitcoin, and I'm going to kind of come back to the origins of crypto as it relates to Bitcoin. But this picture right here, I think, is why many of you might have joined this call. You know, Bitcoin over the last couple years in particular has had a huge run up in prices, in particular over the period of the pandemic. So there you can see kind of really in 2020 and first part of 2021, this year, prices rose dramatically and peaked there above 60,000 this last spring. And so this put Bitcoin kind of front and center in a lot of financial news. And this is probably when a lot of people started investing. Hopefully it was prices were rising, not when they were falling. And then the prices fell pretty dramatically in April and have stabilized and started to come back. But this type of volatility is very common, not just for Bitcoin, but all cryptocurrency. And so people kind of are still kind of wrestling with, should I invest? Is now a good time? Is this just pure speculation? Or can I think of this as kind of a form of almost like investing in stocks? You know, the stock market goes up and down. Well, before we get too much into the kind of recent trends in crypto prices, let me just give you a quick history lesson, if I may. I like to kind of go back in time and use that to help us understand the present. You know, money has taken all types of forms. And so when we think about like digital money or cryptocurrency, some of us can think of that as being incredibly radical and, well, you know, it's not based on anything. Does it really have value? And that can be hard to wrap your head around. But I would remind you that human civilization has used many different forms of money since the beginning of human civilization. So we've used rocks, we've used shells, people in prison have used cigarettes, anything that can be exchanged as a kind of transfer of value, that those things have been used over history. And I think gold is a great example of a physical form of money that eventually moved from kind of rocks into gold coins, something that could be used as a means of payment. And gold doesn't have any particular intrinsic or inherent value. You know, it's not as useful as copper or steel, but it's rare and it is attractive and people have attributed it value to it. And so even today it is viewed as a form of investment. So you've probably seen commercials on TV about, you know, if you're worried about the economy or the stock market, buy gold as a store of value. So that principle is still there. And I think sometimes today think of money as being kind of much different than that, because we now associate the idea of money with the US dollar. Well, the US dollar at one point in time was backed by physical gold. That's part of what gave the dollar value. It was anchored using the gold standard. But if any of you follow kind of some of this type of financial news, we actually just marked the 50-year anniversary of going off the gold standard in 1971. That was under Richard Nixon. And so for over 50 years, the US dollar has not been backed by gold. It is what's called a fiat currency, which means it is only given value based on the faith and trust given to the US government. Now, I think people like to think that the dollar has value because of that backing, but in truth, it really is only the degree to which you give faith in a government. Now, for some people, that's very reassuring. But I think there came a period in time where people did start to question that. And so moving fast forward all the way up to 2008, that was a period in the financial crisis. It's in particular the fall of 2008. That was when Lehman Brothers, the investment bank on Wall Street, collapsed and was allowed to fail. And the financial system globally went into meltdown. And people started to question, is my money going to retain value? Are these financial institutions going to survive? Now, what's interesting is that's actually precisely when Bitcoin was introduced. So in the fall of 2008, bitcoin.org, a website, posted a white paper. And just to show you, this white paper is very easy to find, and I would say very easy to read. So this is on bitcoin.org. It's about a, I think, 8 or 9 page document. And if you want to just go back and try and understand where did all of this get started, this is a great place to go. So the title is Bitcoin, a peer-to-peer electronic cash system. So I think of this as the introduction of digital money into our financial system. So we've been evolving for a very long time away from physical money. We introduced checks many years ago. Then we introduced electronic payments. Most of young people like Generation Z, they don't carry physical cash. They're using smartphones and mobile payments or credit cards online to make payments. And so we are shifting towards a cashless society. And the US is actually behind other economies in this regard. China is shifting even faster than us. Sweden is now 95% cashless. And so in many ways, money has become electronic, but electronic money isn't the same thing as electronic cash, because when you're using Venmo or Zelle or many of these other peer-to-peer systems, you're still linking to a bank account, and all of that's running through the traditional financial system with a lot of transaction fees associated with those different steps. And so the idea behind Bitcoin was, how do we introduce the idea of cash, which isn't linked to a bank account in some way, but it is not physical, it is electronic. And so that's really what I think of when I think of cryptocurrency, is a form of digital money which is native and only exists on the internet. Now, for some people, that's kind of frightening, because they, if it doesn't have physical, if you can't hold it, if you can't put it under your mattress, then how do I know it has real value? Well, for most of us, all of our money, or most of our money, is just zeros and ones on our bank account through some website. So I would argue that that's actually not that different. And so we're very comfortable, I think, nowadays with electronic, but this is electronic cash, which is not connected to a bank account. And I think that was a natural evolution of the financial system, because as we're moving digitally, it makes sense that we would want some form of digital currency. I think actually with the internet revolution and how much our economy and the way we do work and business over the last 20 or 30 years, it would kind of be weird if we weren't experimenting with some sort of digital cash. So I view this as a natural evolution, and Bitcoin was really kind of the first step in moving in that direction. Now, if we go back to the Bitcoin price and you look at the entire history, Bitcoin for many years was trading at values that were, in the hundreds, or even if you go further back to closer to 2008, $5, $10 per Bitcoin. And there's a lot of stories about people who were early investors who are now multimillionaires. But they were, those are very kind of, I think, forward-looking people, or people that were early adopters. And there's also a lot of stories about people who own Bitcoin but aren't able to access it. And I think that's also given people some fear around owning cryptocurrency, because they're worried that somehow they're going to lose it, or they'll lose their password. There are some risks around that, which we'll come back to later. But if you look at this price history, this period actually in late 2017 was when we saw this run up of Bitcoin to 20,000. That was kind of I think one of the most recent bubbles in crypto, where a lot of people got very excited in late 2017. This was going to be the money of the future. And then the bubble popped and prices came back down pretty dramatically. And this period kind of through here, 2018, 2019, is often referred to as like the crypto winter because of that collapse in crypto prices. But going into the pandemic, as our economy and our society shifted online, there was even more shifting towards digital kind of life, digital currency. And so there was a lot growing interest, I think, in Bitcoin and cryptocurrency. So that kind of resulted in this huge run up into this last spring. And a lot of you are probably people who bought Bitcoin over the last year or two, which I think is great. There's a lot of kind of reason to think that, if optimism is growing about Bitcoin, then this would be a good time to invest. Some people might call that speculation, but with Bitcoin, one of the questions is, how do you value cryptocurrency? It's not like a stock or a bond that has some sort of cash flow and you can do a discounted cash flow analysis. It's not producing anything. That's part of why people like Warren Buffett and Bill Gates, many of the kind of more traditional people in our economic system, they I think are very skeptical, and they would say this is just a Ponzi scheme. It's worthless. But I would argue that that's not really the right way to think about money. So money has value if people are using it. It is a medium of exchange. And so if other people are willing to receive Bitcoin as a means of payment, then it will have value. And so part of what we're seeing with this run up in crypto prices are what you could think of as network effects. As more people start using crypto and adopting crypto, then the value of owning crypto increases because it has more functionality in our economy. So there were some questions. Leslie asked a question in chat about El Salvador. That's a good example of an economy, a country, which recently, earlier this year, kind of declared Bitcoin as legal tender in their country. Now, there's a lot of debate about whether that's a good thing or bad thing. There were some of their merchants that were very opposed to this, but El Salvador has had some issues with their currency in the past, and one could argue this is a way to kind of stabilize things. And regardless of how it plays out in El Salvador, it does indicate kind of one step in this direction of using cryptocurrency, not just as an investment for speculation, but actually as a means of payment. And there are a lot of things that El Salvador has done to kind of try and lock in that transaction price, because one of the concerns with this volatility is, well, if I buy something today, how do I know that what Bitcoin prices are tomorrow? Well, they've built in this kind of immediate conversion so that you are immediately converting at the price listed with the price of Bitcoin. So there's certainly ways that you can do this even with a volatile currency. James has a question. Go ahead, James.
Okay, James, you're able to unmute yourself.
All right, maybe we'll come back to James.
Yeah, we can come back. I'll make sure he can unmute.
Okay. All right, so that gives you a little bit, I think, of the flavor around kind of the history of cryptocurrency, how it got started with Bitcoin. Another thing I would like to emphasize is what makes cryptocurrency unique. And I would say that that comes back to something which is the cryptocurrency is built on, which is the technology of blockchain. If you're trying to understand cryptocurrency, you really have to spend some time trying to understand blockchain, because it's the technology that makes cryptocurrency work. If you come back to this like Bitcoin white paper, one of the things that it highlights is what's called the double spend problem. If you are creating digital or using digital money, what is to prevent that money from being duplicated and used twice? So if you think about physical cash, the Federal Reserve spends enormous resources to try and prevent counterfeit. You know, if anybody could print a $20 bill in their basement, that would cause our monetary system to collapse, because then anybody could just create money and spend it, and then the value of the dollar would collapse along with it. And so we need to ensure that each $20 bill is unique and has value. So blockchain is a way of ensuring that digital currency is unique and has value. It's basically a ledger system which exists on the internet, not in some sort of bank server or internal private account. It is a public ledger which keeps record of every transaction in the Bitcoin network, so that we know exactly which Bitcoins are where and when they are transferred from one wallet to another. And so when you're thinking about the importance of blockchain, one thing that I would encourage you to look into is something called a blockchain explorer, because it's a great way to visually just see how blockchain works. If you go to blockchain.com, for instance, you can see the Bitcoin Explorer, you can see the Explorer for other cryptocurrencies. And here you can see the list of all blocks that are being recorded on the Bitcoin blockchain and all of the most recent transactions. So even though many people think of cryptocurrency as being opaque or the dark web, the idea of blockchain is actually that every transaction is public. And so we can see right now in real time every transaction that's being executed on the Bitcoin blockchain. And we can see, if you click on any of these unique transactions, there's a unique hash for that transaction, and we can see that Bitcoin is being transferred from one wallet to one or more other wallets or addresses. This, I think, is an important point, because in a ledger sense, blockchain is incredibly transparent. Every transaction is recorded for everyone to see. And this is actually the process of mining that supports this Bitcoin blockchain. So we need some system for verifying transactions, and that's what the miners are doing. Now, I realize there's a lot of concerns right now about the energy costs of mining. That's part of why crypto prices have fallen, because people are kind of paying more attention to that. I personally believe that this is a temporary kind of issue that it is being worked on. So mining is becoming more efficient. A lot of it's now using green energy, using excess energy that would have been wasted. Those are a couple things that to keep in mind. And then also, as I'll explain in a little bit, the process of mining itself is shifting. A lot of cryptocurrencies like Ethereum are shifting from proof of work to proof of stake, which is a different way of maintaining a blockchain, and it's more energy efficient, among other things. So I don't view the kind of the energy concerns as to being some kind of Achilles heel of crypto. I think it's something that people are trying to figure out. Now, there's several comments in the chat about like illegal activity and other concerns around cryptocurrency, whether it's being used for money laundering or drug trafficking. Now, I would admit that that activity exists. So Bitcoin and other cryptocurrencies by design are what are called decentralized. So there's no governing body, there's no institution that sits on top of it that somehow is sort of regulating the cryptocurrency itself. And so it is kind of an unregulated space of the financial system relative to traditional assets like stocks and bonds. So with blockchain, you have a distinction between what's called the public key and the private key. So what we can see right here with these addresses is sort of the public reference to each account on the Bitcoin blockchain. So we can see for that account whether money is moving in or money is moving out. You can think of that as kind of a digital wallet. But what we don't know is who the owner of that address is. And so this is where crypto is incredibly private. There's no way, unless you actually are able to somehow hack the private key, for you to know what person is associated with that account. So this is why crypto has been used for some of these illegal activities. But I would argue several things as to why I think that's changing. First of all, I think people are starting to see all the legitimate uses. And so as we get more legitimate use, I think that's going to start dominating the illegitimate use. There's just more and more kind of, I think, good actors entering this space relative to the number of bad actors. And if you think about like the history of innovation, I think it's often that type of progression. They're like, the Wild West in the US. How do we think about that? Well, there were a lot of bad things about the Wild West because, there wasn't as much law and order. And so we can view that negatively. But it was also a period of interesting innovation and exploration. And, so as we are kind of entering new territory, which we're doing with crypto, we're going to get that mix. But I think more and more people are starting to discover these legitimate and valuable applications. The other thing I would point out is that regulation of the crypto space is increasing. So even though crypto itself is inherently unregulatable because it is unattached to any country or any bank, and so regulation is based on sovereign institutions or corporate institutions, neither of which apply to crypto. But as soon as you start talking about buying crypto using fiat currency, you are now talking about a regulatable transaction. And so I often tell people that if you're curious about buying crypto or getting into this space, if you haven't already, then I think Coinbase is a great place to start. So Coinbase is a US financial exchange. It actually went public earlier this year, so it's traded on a US stock exchange. It is a highly regulated financial institution. And so if you're worried at all about just some of the risks associated with crypto, from just kind of whether you're going to lose your money or you're going to put it in the wrong place, I think this is a great place to start. But one of the things my grad students and I had a great conversation about earlier this week is when you sign up for a Coinbase account, you have to fill out all types of information, personal information, financial information. This is all based on US regulations because Coinbase is a regulated US firm. And so when an exchange creates this kind of transaction between the US dollar and crypto, that becomes a regulated exchange. And so we were talking about how some international students were having issues using this because they don't have those US credentials. There is in money transmitter regulations, there is something called Know Your Customer or KYC. That's why Coinbase is collecting all that information to comply with KYC regulations. Also, if you think about the tax implications, there's been a lot of comments recently about whether crypto is untaxable or taxable. The US Congress is starting to pay a lot more attention to this. And in response, the IRS has started sequestering information from Coinbase to look at what are the large accounts, where are we seeing capital gains, and who are the owners of those accounts. So using a centralized exchange like Coinbase, these are now taxable transactions that the IRS can view and track down. And so regulation is going to start shining more and more light in this area. And that's put some downward pressure on Bitcoin prices, for instance. So if you look at like these price trends over the last year, part of this sell-off that we saw earlier this year in the spring was driven by increased regulation. A lot of that was actually in China. They're starting to put more pressure on mining and the ownership of crypto assets. But as you can see, things have stabilized, and I think there is a growing realization that certain amounts of regulation are going to help this space. As we see more institutional investors, we're going to see more regulatory guidelines. For instance, institutions that want to own cryptocurrency have a lot of regulations around custodial issues. Who actually holds the asset? And so all of that's been worked out for stocks and bonds, but cryptocurrency is an entirely different asset. And this whole idea of blockchain and who actually can access that account using the private key, that becomes complicated, because then it's really only the holder of the key who can access that account and transfer value. So for an institutional investor, do they hold the key? Does a custodian hold the key? That's become things that have become more complicated. And as Cody mentioned in the chat, not your keys, not your crypto. So another thing I would emphasize about all of this is now kind of where things have gone since 2008. So my guess is many of you are interested in not just Bitcoin, but the entire crypto market. Here is a list on CoinMarketCap of all the cryptocurrencies that now exist. So you can see Bitcoin is still the largest by market capitalization. And so I think it is still a great place to start when you're trying to understand this space. And if you're investing, I think a good place to start in purchasing cryptocurrency. But there are now hundreds and thousands of other cryptocurrencies on the market. So why are we seeing this proliferation of cryptocurrencies? And I would say many of these are actually not even intended to be a form of money. This is actually, I think, the creation of a financial market. And what brings us back to this concept of investing. So one of the books I just wanted to mention to you that I'm actually reading right now is this book called Crypto Assets by Chris Bernisk and Jack Tatar. And this is kind of what they're trying to highlight, even with this title, is we're evolving from digital money to digital assets. And so people are now starting to buy these other tokens as a form of asset. And many of them have completely different functionality and purposes than Bitcoin. So you've probably, I'm sure, heard of Dogecoin. Dogecoin is actually quite similar to Bitcoin in some regards. So it is designed to be a true cryptocurrency, but it has very different functionality. It has a different mining protocol. It has a different supply protocol than Bitcoin. And so the reason we're seeing new and different crypto assets is some people look at the existing ones and they say, well, we could do that differently, or we could build something that would serve this purpose. Kind of like new companies form and then they issue stock. And if you like that new company or that idea, you buy stock in that company. Crypto there's new ideas, new opportunities. And if you want to invest in that idea or opportunity, then you buy the token associated with it. So my one caution would be, don't go too far down that list of different coins that are on the market, because I would say, there's more opportunity, but also more risk as you move down this list. I tend to encourage people to kind of focus on the top 10 or 20 by market capitalization. Do your research and try and start to understand that. And the one that I would highlight next in this kind of evolution of cryptocurrency and crypto assets is this one, Ethereum, or ETH is the cryptocurrency associated with the Ethereum network. So as I've been learning more about this space, I've become more and more interested and excited about Ethereum. So there's a great website, ethereum.org, that you can go to if you just want to learn more about the background. I've written a fair amount about it on my website. So Ethereum was introduced in 2015. There was a team of people. There's a gentleman, Vitalik Buterin, who's one of the real founders of Ethereum. And what's fascinating about Ethereum is it is not just a currency. So Bitcoin was really created as digital currency, really solely for the purpose of moving money on the internet, which is important. And I think that's what cryptocurrency can do very well. But Ethereum takes this to a whole nother level, because Ethereum is also built on blockchain, and it still has a cryptocurrency associated with it called ETH. But with Ethereum, you can build applications on the Ethereum blockchain. This is something that Bitcoin was never really designed to do. And so blockchain has many applications. Money is only one of them. Blockchain is like a record system, a system for recording information. Many people are trying to apply this in different corporate and enterprise applications like supply chain or even healthcare. How do you track individuals? How do you track products? How do you do so in a way that is immutable, that is more secure? Blockchain is very powerful for that. But what Ethereum is doing is saying, okay, well, if we create this underlying infrastructure for recording information and sharing information, can we start to build applications on that platform? And so just like Apple introduced the iPhone and the App Store, where application developers can create new apps that are then on the Apple platform or now on Samsung or Google, we're now seeing blockchain being introduced as a platform that you can build applications on. And so what this is called is decentralized applications, or dApps. And so one way to think about this is blockchain is decentralized. No one controls it. No one governs it. And so if you build an application on a decentralized platform, then what you're building is a decentralized application. Now, the reason I think this is so powerful is because Ethereum introduced the idea of a smart contract. This is a contract that exists on the Ethereum blockchain that is really just like a short set of code that is designed for users to be able to interact with that smart contract. And so you can buy and sell Ethereum or Ether with another user of the Ethereum network, like an individual. I could transfer my ETH from my account to your account or vice versa. But smart contracts are an account that exists on the Ethereum network, which is not owned or managed by an individual, but it's like an automated transaction service. So what that means is people have started to create smart contracts that provide a service to users of the Ethereum network. And so if you look at like an Ethereum Explorer, which is recording all the transactions on the Ethereum network, kind of like we looked at the Bitcoin Explorer. So Etherscan, I think, is the most popular Ethereum Explorer. Here you can see this very recent transaction. This was just a couple minutes ago. And this is an account of an individual user that is interacting with a smart contract. And so this action is they're interacting with a smart contract in order to achieve some sort of outcome, which is related to these decentralized applications. And the reason I emphasize this is because if you're thinking about starting to get involved in cryptocurrency and owning cryptocurrency, I would encourage you to buy crypto on, let's say, Coinbase.com. But at some point, you're going to want to think about creating a digital wallet. And so an example of a digital wallet is something called MetaMask. MetaMask is called a browser wallet. So it's you actually managing your own digital wallet. You, in a sense, will own your own private keys. And it allows you to start interacting with these blockchains like Ethereum. Notice here this kind of tagline that MetaMask has, a gateway to blockchain apps. And so, as Cody mentioned, layer 2, there are all these applications which are layer 2, which are being built on the underlying layer 1. And these applications are now not just currency, they are services. So the one that I have become particularly interested in is this area called decentralized finance, or DeFi. So DeFi is an example of a decentralized application. And now we're talking about a crypto market or universe, which is providing a service, not just a store of value. These things become more easily to value, because if you think that service is going to become popular, then you might want to buy the token associated with that service. The more people use that service, the more the value of that token will increase. So just to give you an example of one of these DeFi applications, Uniswap is a cryptocurrency exchange, which is very different than Coinbase because it is solely a blockchain application. It is built on smart contracts, and it is designed to buy and sell crypto. So you could swap Bitcoin for Ether on the Uniswap protocol. And it's basically like an algorithm for trading crypto. So rather than having a corporation that is going to kind of create its own trading rules and then kind of manage those trading rules, let's create a set of code which just says, okay, if we get a buy order at this amount and we have a sell order at this amount, we have a matching algorithm to put those transactions together. That's part of the power of these of DeFi, is we're shifting from human corporations to digital algorithms, which are much more transparent and I think more efficient. Now, that might start to kind of blow your mind a little bit if you think, okay, well, how did we get here? Well, if you look down on this list on CoinMarketCap, you can see that Uniswap has a token associated with it, Uni. Now, Uniswap's actually under some regulatory scrutiny, so I'm not necessarily encouraging you to buy right now. I don't have a short-term forecast for Uni, but this is a DeFi protocol associated with a crypto token. And if you think this application, this decentralized application, has value and it will be used more in the future, this is a good opportunity to buy Uni, because the more people that use this crypto exchange, the value of that token will increase. So this is one example of how these layer 2 tokens are not really cryptocurrency, and they're not just kind of standalone assets. They're more like an equity, like owning a share in something. If it's more profitable, then the value of that share will increase. And so as you're moving into the crypto space as an investor, I would encourage you to start with some of these traditional cryptocurrencies like Bitcoin, but then to start exploring some of these layer 2 applications, which are more they have an investment thesis. It's not just like, you know, do I think things are going up or down, or doing solely technical analysis. With some of these, you can see how much users are engaging with that decentralized application. You can predict future user engagement, kind of like you would with a social media platform. And then if you are optimistic, then you would want to buy into that token. Now, several people have mentioned, you know, there are a lot of transaction fees associated with blockchain. Gas fees in the Ethereum network are still relatively high. And so blockchain has a long way to go in terms of scalability for these types of applications. But I think the potential is there, and a lot of people are trying right now to figure out these scalability options. One other thing I would highlight from this list on CoinMarketCap are this one here, USD coin or USDC, and this one here, Tether or USDT. So these are referred to as stable coins. They are created as a cryptocurrency with the purpose of functioning as digital money, but their value is pegged to the US dollar. So these are basically like the digital version of the US dollar. One USDT, $1, one USDC, $1. Now, what's interesting about stable coins is they were created precisely to solve this volatility problem. Many people said, well, crypto is never going to be money because it's too volatile. Well, stablecoin is crypto that has no volatility relative to the US dollar. And so these stable coins are starting to play interesting roles in the crypto network, not so much as an investment, you know, you're not betting on price speculation. They are more kind of like a deposit account. Now, they're not FDIC insured, but they are a holding place for US dollar coins, which you can then deploy kind of like a cash account that you would employ in your investment portfolio. Now, Max asked about, you know, Tether Scandal. So one of the questions is, if you have a digital coin that is backed by the US dollar, how can you ensure that that peg is sustainable? So just like the US dollar was once backed by gold, part of why Richard Nixon went off the gold standard is because gold reserves in the US were falling, and they were worried they wouldn't be able to maintain that peg. And so that question has come up for Tether and USDC. USDC now has a lot of audits to make sure that those dollar reserves are sufficient to maintain this digital peg. So anyway, I think that highlights an interesting trajectory for crypto. So it's not just about speculation, it's about stable coins, which can be used in these interesting kind of digital environments. And that highlights that a lot of central banks are now looking into cryptocurrency. There's this thing called central bank digital currency, or CBDC. Will we at some point have an electronic dollar? So the People's Bank of China has already run a pilot program for the Chinese renminbi. Sweden's central bank is piloting a e-krona in Sweden. So I think it's only a matter of time before the Federal Reserve really has to get serious about this. But in no way do I think that is going to somehow replace crypto. I think whether we're talking about the US dollar or the crypto market, we might see central banks issuing digital currency. We're seeing crypto introducing stable coins. And so the two are moving together and becoming more similar, but I think they still maintain different functions within the market. So they will, I think, continue to exist alongside each other. So Alan asks a question about the market. So there are now indices which are being created in order to try and help you diversify your crypto assets. You know, I would say for early investors, you know, I would start by just buying sort of a spectrum of those high market cap coins. There's some people who talk about the bed portfolio. Bitcoin, Ethereum, and DeFi. And there are DeFi indexes that you can purchase rather than individual coins. And so there, I think more and more in this market, there are opportunities to diversify. All right, so let me wrap up with one concluding thought. And I know there's questions that I missed in the chat, and then also maybe we can take some audio. One of the things I've actually had a conversation with my data analytics students earlier this week. With these applications and decentralized approaches to doing business, I think what we're starting to see is also a different approach to the internet itself. So the traditional existing internet is built on servers, and I think largely centralized around the big tech companies like the Googles and Amazons of the world, even cloud services. But there are now more people in the blockchain area that are saying, hey, how do we build a decentralized internet where you're not giving away your data with every search, with every click, and it's not owned or governed by any of these large corporations? So that there was some discussion I saw in the chat about Web3. And so that, I think, is, I start to think of as some of the frontiers of this space. Non-fungible tokens are also super hot right now. Not at all currency. Non-fungible tokens are unique digital assets, and then you have a record of ownership. Being able to own a digital asset, something that can't be copied or duplicated or shared amongst others, that becomes something of unique value, which is part of why I think we're seeing so much interest in this in the art world, because as art becomes more digital, we need a digital record of ownership, which is exactly what non-fungible tokens are designed to be. So anyway, I think there's super interesting directions for this space. And I hope that's given you a little bit of background, maybe that will be helpful as you think about this, both from an investing perspective and just from a learning perspective. All right, so I realized that the chat was going by quickly and I missed a bunch of stuff. Maybe if there's either hands or someone who had something from the chat, if you want to repost it, we've got about 6 minutes to try, and I'm happy to take any questions.
Wow. Okay. First, I just wanted to thank you, Professor Black. That was a lot of information. Really good. Thanks everybody for coming out. And as far as the questions, I'll look and then I'll grab the people with their hands raised and we'll monitor the chat too, okay?
Great.
All right, we have someone here. I'll go ahead and allow them to talk.
Hello.
Go ahead, Ashish.
Okay. So Professor, my question is, I know Bitcoin has it does have like the mining doesn't like always continue. Like it has a I don't know how to explain it, but in 2022 it stops mining. So like there's a fixed amount of supply for it. So how does that once that fixed amount of supply is mined, how does it go on to work after that? How do miners still play a role in this while mining or anything?
Yeah, that's a good question. So there's been a lot of talk about mining because of some of these regulatory changes, because of the energy consumption. So you know, miners have to be compensated in order to do this validation. They're basically running, if you kind of want to think about it as like an encryption algorithm, and therefore it's very computer intensive. You can think of mining as a voting process. All of these different nodes in the network are voting on whether this transaction is legitimate. So rather than having a trusted third party, the network itself is verifying transactions. So mining is super important. And miners are compensated both in terms of new Bitcoin, in the case of Bitcoin, or new cryptocurrency, but also part of the transaction fee associated with that. And so I think, you know, miners will continue to receive compensation. I think it's not like the Bitcoin network will come to an end even when all the Bitcoin has been produced. I think what's more interesting and potentially more relevant is how this, what you can call consensus mechanism, is changing. So Ethereum is in the process of transitioning from mining to staking. And so if you're interested in this kind of verification process, I would strongly recommend everyone to try and do more research on staking, because I think that's kind of the direction that a lot of the crypto market is headed in.
Yeah, thank you.
Yeah. Did I convince anyone to invest who's not an investor already?
Well, I do have one more question, and I don't know if it's okay for me to ask if there's anyone else.
Yeah, go ahead. I think we're about out of time, so go for it.
So my other question is, how do currency exchanges work? So, for example, if I'm renting out a property in India and they're paying me in rupees, but I tell them, hey, I accept crypto now, and I'm in the US, would there be any sort of like procedure for that, or would currency exchanges like completely go off rail if the world does move into like cryptocurrencies? Like,
Yeah, I'm glad you asked about that, Ashish, because that is a sort of one of, I think, the important applications in the crypto area is these cross-border transactions. So dollars and rupees work very well in their local economies, but there's a lot of fees associated once you start moving currency across borders, whereas crypto is borderless. And I think there's a lot of crypto which is being used for remittances, so people sending money back to their home countries, and in your case, potentially earning money in those home countries. And so I think that's going to prove a significant threat to like the Western unions of the world and the whole wiring process, because crypto is really a global currency. Now we're going to see more regulation that's going to potentially complicate those cross-border movements, but ultimately, I think crypto was designed to be global, just like the internet.
great, thank you.
Yeah.
Thanks again, Professor Black. I know we ran out of time here, but again, thank you all for joining us today. And it was a very interactive webinar, so thanks again. And if you had any last remarks, I don't know, to the people who joined.
Yeah, will you be sending the recording to participants? Is there a way
Yes.
to do that?
Yes, so the recording will be made available within 2 weeks, and then we will let everyone know, and we post it on the blog.
Great. And if you want to follow up, feel free to reach out through my website or on LinkedIn. I'm happy to keep in touch, especially on LinkedIn. I'm pretty active there.
Perfect. Thank you so much. I hope everybody has a great weekend.
Take care.